It's that time of year again, guys, where if you have an employer, it's open enrollment season, which means you might have questions around, for example, what is an HSA account versus an FSA account? A health savings account stands for health savings account, whereas an FSA account stands for flexible spending account. Now, the differences between these two types of accounts is night and day, so you want to make sure to pay attention to this video and subscribe to my channel if you do enjoy content like this. As part of enrolling in a health insurance plan, typically with your employer, you may have the option of choosing between an FSA account or HSA account. Now, if you have a lower deductible plan, such as a PPO or a PPO Plus, in that event, you should be eligible to enroll for the FSA account. Conversely, if you have a high deductible plan, at that point you would be able to enroll in an HSA account. First, let's cover the similarities among both of these types of accounts. So, generally, both the HSA and the FSA accounts are tax advantaged accounts. And what that means for you is before you even get your paycheck, that money, whatever you allocate, is deducted from your earnings pre-tax. And here's why that's valuable. Let's say you spend about $1,000 a year on medical expenses. And typically, if you were to use your credit card or debit card, whatever the case is, that's going to cost you not only $1,000, but that's actually $1,200 or more, or maybe a little bit less of your gross income, because that is post-tax dollars that you're using. That's money on which you've already paid taxes. Whereas if you employ an HSA or FSA account, you're going to be using pre-tax dollars. So that $1,000 is actually $1,000 of your gross income. So really, HSA and FSA dollars are a lot cheaper to use for medical expenses. In addition, both cards can be used for any qualified medical expenses, both for you and your dependents in the event that you have a spouse or a child enrolled in that health plan with you. There's a comprehensive list on the IRS website and also some other websites, so I'll leave a link down below that you could check out to see which expenses may be qualified. But long story short, really any medical related expenses such as co-payments for doctor visits, co-insurance payments, any prescription payments, anything related to optical or dentist expenses, really anything of medical necessity, any accessories, including some hygienical products. So really it's a very powerful tool and you can really use it in a lot of different ways. Now, which of the two accounts is better? Generally, I say it really depends, but I'm going to be blunt here. The HSA is by far the best type of account you could enroll in. It's 100 times better than the FSA account, and here's why. Let's get into the details. For one, whatever amount of money you contribute to your HSA account, it's yours to keep forever. You can keep it, invest it, it's yours forever. As opposed to the FSA account, which is more of a use it or lose it type of model. So really, let's say you're going into the next year, 2022, for example, and you have an FSA account and you want to allocate $1,000 for that year. Well, guess what? If you don't have $1,000 of medical expenses, all that money in that account, it's gonna disappear by the end of the year, or really they give you a little bit of a leeway, so about 2.5 months into 2023. But long story short, you find yourself having to plan for exactly how much you'll need in expenses with an FSA account, because if you don't use it within that calendar year, it's gone. It's not yours anymore. Number two, you can actually invest with the funds in the HSA account. You can buy stocks, ETFs, or what have you, whereas with the FSA account, it's just going to remain cash. Point number three, you can actually contribute a lot more to the HSA. So if you're a single person, I think that's about $3,650, whereas if you're a family, that's double that, so about $7,300. If you're above the age of, I believe it's 50 or 55, you actually have an additional $1,000 you could contribute to that HSA account as a catch-up contribution. Whereas with the FSA account, that's only limited to $2,850 for the following year. And again, there might not even be a point in maxing out an FSA account, right? What if you don't have, or what if you're not planning to have $2,850 worth of medical expenses next year, versus if you were to max out an HSA account, that money is yours to keep, so you don't have to worry about it. Point number four, sometimes your employer might actually help you out and pre-fund your account. For instance, some companies that I know of they do provide $500 or $1,000 a year and fund that HSA account for you before you even put in your own money. So that's just extra money on the table. Whereas with an FSA account, that's really rarely the case. They never really contribute for you. Now, it's not all ponies and rainbows with the HSA account. You do have a huge disadvantage with the HSA account. And as I mentioned previously, that disadvantage is that you do have to be enrolled typically in a high deductible plan. And what that usually means is more upfront costs. Every time you go to a doctor visit, instead of a co-payment, you might have to pay flat out the entire cost of the visit. So typically you find the younger generation, younger folks that are unmarried, don't have children, or don't require as much medical attention. Those are typically the type of individuals who do enroll in a high deductible plan, and it's best for them to really max out their HSA account if they are eligible. So that's one caveat of the HSA account, unfortunately. At a high level, think of it like this. If you are able to invest in an HSA account, the main advantage is not only is your employer going to potentially contribute $500 or $1,000 or more dollars into your account, which is literally free money that they're giving you. Besides that, let's say you do max out to that full $7,300 and your average tax rate is about 15-20%. That's probably the average. So you're saving, you're actually getting $500 or $1,000 from your employer. That's number one. Number two, how much money do you save on being able to use $7,300 pre-tax dollars for medical expenses? About 15 or 20% of that. So let's say $1,400 that you're saving on taxes by funding that HSA account with $7,300. So all in all, that's about $2,400 on average that you could save. It's extra money, free money that you're getting as long as you max out that HSA account. So it's really powerful and it really does add up. Not to mention, as I mentioned previously, you're able to invest with the funds in an HSA account, and that money actually grows tax-free. So HSA accounts are actually the only type of triple tax advantage accounts, and what that means is when you're funding the account, you're not paying taxes. When you invest the funds in that account, you're not paying taxes on the gains. And finally, when you use or expend all that, all the funds in the HSA account, as long as it's for medical related expenses, you're not paying taxes. So at all three entry points, you're not paying taxes as long as you have an HSA account and you're using it properly. So it's definitely a very powerful tool. So that about sums it up. Folks, if you're not taking advantage of an HSA or an FSA account, come on, get your act together, get your finances in order, do what you can. It's literally free money on the table. Take advantage of it. Even if you don't have access to an HSA account, but you have access to an FSA account, just try to predict what your upcoming expenses might be. Do you have dental fillings coming up, any kind of root canals? Do you have any pregnancies in the family that you'll need? Just kind of plan for the future and accordingly allocate that money in your FSA or HSA account, and it's literally going to pay you dividends. That's it for today, guys. Be sure to subscribe to my channel because that's going to pay dividends as well. Thank you.